The yen carry trade and the potential unwind of that is creating a lot of volatility on the stock market. What does that mean? Will it continue? And what should you do? I've got that and more coming up. My name is Mike Bernard, I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Historic levels of volatility to end last week and start the trading week this week. The Japanese stock market dropped over 12% in one day on Monday of this week. And that actually is the second biggest one-day decline by that stock market ever, only surpassed by what we refer to as Black Monday in Wall Street, the October time period of 1987. In fact, due to when those markets are open, the futures for the U.S. markets were signaling a decline of 4 or 5%. Didn't trigger the circuit breaker, but was close to it. And there was some chatter within social media that, oh my goodness, are we going to see another sort of Black Monday event? Thankfully, that didn't happen. The U.S. market on Monday was only down about 3%. The Dow was a little bit better. NASDAQ was a little bit worse. And a lot of the big names were down double digits, 10% or so, but ended up only finishing down 6 or 7 only, right? So the volatility in the U.S. markets turned out to be a lot less than what many feared that it would be. But what caused this? And are we out of the woods? I don't think so. So markets are global, and what is causing a lot of this is something called the yen carry trade. Now this is complicated, and but I'll try to break it down in a really simplistic way. But the Japanese economy has been such that really they can't afford to change their interest rate, and so they don't move their interest rate that much. It's remained at very, very low levels despite this inflation that's obviously impacted the U.S. dollar and sort of the cost of global goods, right? But they haven't really been able to change their interest rate. And so what this yen carry trade has been for a long time is people would go out, investors would go out, and they would borrow yen, okay, because the interest rate was so low, essentially nothing, and it was very little cost to borrow yen. They would then convert those or exchange those to US dollars, and then they would use those US dollars to invest in something. And let's just make it very, very simple. If interest rates in the US have risen because of inflation, and interest rates on a treasury are now 5.5%, let's say, it's a little bit less than that now, you could borrow yen at next to nothing, exchange those yen into dollars. As long as the exchange rate stayed stable and the dollar stayed stable against the yen, you were fine. And then earn 5.5% almost risk-free on those dollars. And it was an arbitrage play, a way of making money by kind of working the system. So it was those three components. And I don't know, I don't want to speculate, and I certainly don't want to spread rumors, but apparently the number of people doing this, or the amount of the financial magnitude of this trade, is in the trillions, apparently. Now, what could go wrong? Well, first, if the interest rate rises on the yen, if Bank of Japan does that, well, but they can't really do that because of how their monetary supply is, their economy is. They can't really do that, except they did last Thursday, right? For the second time in 17 years, they raised their interest rate. Not a lot. They didn't raise it by 1%, but just 1/4%. But if they raise the interest rate and you borrowed against yen, now you have a bigger interest that this is going to cost you more, right? So that's one problem. Second problem, what if the exchange rate between the yen and the dollar worsens? What if the dollar weakens? Well, that's not going to happen, right? Yeah, the dollar is actually weak right now, and therefore when you're exchanging your yen and the dollar, it's going to cost you more dollars to convert back. That's the second problem. Third problem, what if that investment that you chose to make with these dollars that you borrowed from yen, complicated, you didn't invest in U.S. Treasuries, you invested in something that had a much better payoff, i.e. stocks or whatever, and those stocks actually go down. We had all three of those things happening right now, essentially. The interest rate on the yen, the Bank of Japan raised the interest rate problem number one. Number two, the exchange rate got stretched, problem number two. And third, stock investments in Japan as well as the US have been going down. When that happens and you've done this maneuver, all of a sudden, because you've borrowed, you then have to sell at a loss to then start recouping and making sure your ratios are in alignment, or even find a way to back out of this trade. And either way, you are having to sell no matter what's happening. Oftentimes when markets are going down, you don't want to sell, wait for things to recover, you want to sell high. Well, you're forced to sell if you need to get out of a trade or if you've borrowed on margin and you need to keep your ratio in a certain level. So that's what sparked this enormous sell-off in the Japan markets on Monday, and the expected sell-off, still a big sell-off in the markets here in the U.S. On Monday as well. Now, recording this video right at the start of the day on Tuesday, the Japanese markets overnight rebounded significantly. We're up 10%, one of their best days ever. Now, if you lose 12%, you need more than 10% to get back to even. The stock market in Japan was up nearly 20% just a month ago, and as of yesterday, it was actually negative for the year. And so this positive 10% is moving back in the right direction. U.S. markets, at least futures, while I'm recording this, appear that today is going to be a little bit of a better day. But this, as you can tell, this is a very complicated maneuver. There's a chance that it's not over and that it creates more volatility moving forward. You take that on top of the trifecta or three different pieces of bad economic news, and you've got a little bit more volatility than certainly we've seen in a while here on Wall Street. On Friday, or at the end of last week, we had, surprisingly, consumer spending declined. If the consumer is not healthy or strong, the economy is going to struggle. The consumer makes up 70% of the economy. That's one. Number two, employment figures actually came in a lot worse than expected. The unemployment rate ticked up, triggering a recessionary indicator called the SOM rule, if I'm pronouncing that right, where basically it looks at the moving average of the unemployment rate, and if it rises by at least 0.5%, 50 basis points over the moving average from the previous year, that's been triggered. That's a recessionary indicator. And then third, we saw the manufacturing index actually show that area of the economy is contracting, okay? So much of our economy is technology related now, so it's not necessarily, it's still a concerning thing, but it's not necessarily a death knell for the U.S. economy, but that showed signs of weakness also. So you've got the yen carry trade and what that means to the potential unwind and forced selling that could cause, plus these economic indicators showing weakness in the overall economy. Yeah, the backdrop is the Fed might lower interest rates, but if you've got these swirling sources of bad news or headwinds, that could create, and we've seen, a lot more volatility than usual. I would expect that volatility to continue until there's clarity on whether the economy is officially out of the woods. There's been so much talk about, well, did the Fed create a no landing or a soft landing? Are they able to decrease inflation without harming the economy, sending it into recession? So many people have said, well, the verdict's in. It's a soft landing or a no landing. Well, we're starting to see some recessionary figures here. So until we get clarity as to whether the economy's on solid footing and whether this yen carry trade it has more unwinding to go, it's likely that we're going to see a little bit more volatility, some elevated levels. What should you do? Three things. Number one, you've got to confirm that you're taking the right level of risk with your investments for your situation. You've got to look and say, am I taking too much risk for my situation, for my financial plan? Am I taking too little risk for my situation and your financial plan? You want to make sure that both you've got the right diversification, stock bond mix, but that normally doesn't cut it, right? Even yesterday, when markets were seemingly in free fall for a moment, you expected bonds to do well, and they didn't. They actually sort of were flat, so in comparison better, but I was expecting that interest rates would fall, bond investments would go up, and at least that would soften some of the blow, and they didn't. So therefore, making sure that you're taking the right level of risk for your situation is also making sure that you've got the right strategies, hedging and other ways for you to manage risk. So that's one. Number two, tune into your time horizon. Tune into your time horizon. If we do see a time period of elevated volatility, but you're in retirement or near retirement and you are needing to start drawing dollars out, or maybe you are drawing dollars out of your investments, those dollars, and I would say 2 to 3 years of the income that you need off your portfolio should be in cash. So if we do see this yen carry trade kick off a pretty significant economic event and the stock markets really go down and we see a recession, if all of those things, all these fears sort of swell up and become reality, then you want to make sure that your retirement income is not impacted. So you got to tune into your time horizon. That's the second one, and make sure that your short-term dollars or short-term investments are invested in short-term instruments. And then finally, number 3, you need to stay the course. And yeah, no one knows the future. I don't know how bad this could get or if it's already over. We don't know. However, the investment strategies that you put in place that's connected to all 6 areas of your financial plan, they are supposed to play offense and defense. This isn't something where, well, if we get some bad news, we're probably going to need to throw everything out the window and recreate it. No. Long-term investing is picking strategies that are appropriate for your situation when things are going well and going up, and when there's time periods of volatility and there's uncertainty. So work with your CFP on that, your certified financial planner, on all 6 areas of your financial life, but in this specific area, how your investment strategies, that fourth area of your investment life, connects with all the others. Work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us here as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.